One of the questions I get often from family and friends is what stock should I buy? And the reason why I don't like to answer that question is because, well, number one, nobody likes being wrong, and I don't want to be the reason why they lose their hard-earned money. And number two, it's not actually about being right or wrong, but it's about knowing what to do for any outcome. Yes, I can say what I like in that moment, but if some crazy news comes out and shit hits the fan, the real question is, do I know how to protect myself and will I know how to react? And it's hard to explain all that in what seems like should be a simple answer, but us traders know that there's layers to this shit. And some of us may be glued to CNBC, Kramer, digging through Wall Street bets, hoping to catch the next Apple or Nvidia. But if I know how to approach risk and know how to manage it, that beats out trying to lottery ticket my way out of this thing. There's a common saying in the trading world, we're not traders, we're actually risk managers, which is true because we can all get into the exact same trade, but end up with different results. Knowing when to let the winners run and when to cut the losers short and knowing how to hedge in between is what separates the successful traders from the rest. So whether I'm trading from a strong, deep analysis or just simply flipping a coin, if I just know how to manage my risk, I'm much more confident that I can come out the other end okay. So here are some ways how I personally like to keep my risk under control. Now, this is what I like to do. I'm not saying you should do it, but as an active trader, I like to be organized by having separate accounts for the type of trades I'm taking. So I have a day trading account, a swing trading account, and an investing account. This way I don't mess with the objective behind on each position like I would if I had everything on just one account. So for example, let's say I'm in Tesla and my plan is to hold it long term and it gaps down one day and I see a great opportunity to short it just for a quick day trade while still keeping my long-term position. If I did everything from just one account, at some brokerages, I'll be forced to sell my Tesla shares that I'm in before I can short it. Or if I wanted to play it as a long for a day trade, buying and selling can mess up my average price on that long-term position. So by having separate accounts, this for me keeps everything clean. I don't need to worry about overlapping trades. I can get in and out of my day trades without disrupting my long-term positions, and I can manage each of them appropriately. Because different strategies may call for different actions to manage that position. And this way, it also opens up more opportunities for me. Because let's say Tesla goes parabolic on the daily chart, which it recently did, and it's due for a correction and starts to pull back. So if I wanted to swing trade this short, I can do so while keeping my core position and even my day trade, which may seem more like offense than defense. But again, the point here is being organized so that I'm able to manage each position appropriately. So now if I wanted to, in my investment account, I can maybe pick up some TSLQ, which is the inverse for Tesla, and maybe even sell some covered calls on it to bring in some extra pocket change. So instead of just crossing my fingers and waiting and hoping for this thing to recover, I can take action and take advantage of any direction the stock is making in the smaller and longer timeframes, and just being organized and being able to manage and hedge accordingly, which leads to number two, and that is insurance. Buying stocks without knowing how to hedge is like buying a house without knowing about insurance. And if a tornado or a fire ever comes through my neighborhood, all I would be able to do in that situation is hope and pray this shit doesn't hit my house. Not the smartest way to approach it. So if I'm invested in a stock, it's extremely important for me to know how to buy insurance. Because for example, earnings season just kicked off, meaning a lot of companies will be reporting, and that's when the market gets more volatile. But the good news is that we know the exact dates these companies are reporting. So it's almost like that scene from The Big Short where Ryan Gosling's character is pitching to Steve Carell's firm. And he says, let me put it this way. I'm standing in front of a burning house and offering you fire insurance on it. So with earnings dates, it's giving me a chance to buy insurance before it reports. And a great way to do that is using options. Options is a very lengthy topic, so I'm not going to get too much into it in this video, but I did make a few beginner videos on it if you want to check it out. But if I go back to the Tesla example, and let's say the current price is at $250 and it's reporting earnings. Instead of saying, Jesus, take the wheel and sweating it out, I can protect my position by buying a put option. So what that does is I now have a contract that gives me the right to sell a stock at a specific price. So if I buy a put option with a strike price of $250, I now have the right to sell my Tesla shares at $250. So even if I wake up tomorrow and Tesla's decimal point moved twice in the wrong direction, I'm not even feeling a pinch because I have a put option that gives me the right to sell my shares at $250. So all I have to do is exercise that option and I'm good. Whoa, wait a minute. Who's gonna buy it from me for $250 when the fucking thing is at $250? That doesn't make it. Go watch the options video. Now, what if it gaps up to $2,500? Well, my option to sell it at $250 now becomes worthless because I can just sell it at its new market value of $2,500. So in this case, I would just lose the premium I paid for that insurance or for that option, which I'm totally okay with. Because again, this is just insurance for my position. It's just a small price I'm paying to keep my risk under control. Because I'm not waking up every day thinking, fuck, my house didn't burn down today. That home insurance sure was a waste of money. No, I look at it as a cost of living, as a cost of investing, or a cost of doing business, because it gives me better sleep at night knowing that I'm protected. It's understanding that insurance isn't there to make me money, and it's not there for me to walk away without a scratch. It's there to reduce the loss I can take. And as a trader, as an investor, it's important for me to know the tools that are available to me to protect myself. So next, let's talk about hedging. Hedging is a way to neutralize a position that I'm in. It's almost like putting the game on pause. So if my Tesla position starts to come in and go against me, and I'm not sure if it's going to fail here, I can go short the same amount of shares, which would flatline my profit and loss. Because if the price starts to go back up, my long position is no longer making money because my short position is losing the same amount. But if my price goes lower, I also don't lose any money either because now my short position will be making the money on the way down. So like I said, hedging is like putting the game on pause. I'm not exiting the trade. I'm staying in the game, but neutralizing the position as I'm giving it a chance to work. So now if the stock starts to fall apart, I now have a few choices. Either I can exit both positions, which means I didn't lose anything on that failure, or if I think this is just a temporary price correction and I think it's going back up, I can just cover my short position and hold on to my long position as it recovers, and I can get out again if it fails. Or if I'm not sure, I can just leave it and take it off once I see that it's working in my favor again. So hedging, I mostly use to neutralize a position that's going against me, but as you can see, there are certain situations where I can benefit from it as well. Like I said, there's layers to this shit. And of course, there's ways to do this with options as well, with delta hedging, but that would need its own video. Now, what about unpredictable events like 9/11? I mean, type of events that can really take a fat shit on my position. Well, this is where position sizing comes in. Let's play a quick game of poker, no limit hold'em. I've built up my stack to $5,000, and for my last hand here, I have ace king suited, and the turn gives me an ace high flush. Opponent jams all in, and this is an easy call for me, right? Even if my opponent was playing face up and showed 5-6 suited, only one card can beat me, a 4 of clubs, which would make a straight flush. So even though there's an extremely small chance I can lose, there's no way I'm folding here. So I go all in, and of course the 4 of club comes out, wiping away my entire stack that I built up all night, all on this one single hand. So the lesson I learned is no matter how high the probability is, no matter how much conviction I have in a trade, I can protect myself by keeping control of how much capital I allocate to each position. So if I go back to my poker hand, what if I didn't have to match the all-in bet? What if it was my choice to call with any amount I wanted? Because that's the choice I have in the market. How much would I put into the pot then? 10% of my stack? 5%? Maybe just 1%? Well, that's when the river comes out a blank, right? And that's the point. I just never know. So position sizing, not going all in on one individual stock, risking only a small portion of my total account per trade helps keep my account alive even after those bad beats on the river. Like I said, I'm not trying to lottery ticket my way out of this thing, even though I want things to happen now. But for me, the game of trading and the game of investing is about lasting and compounding. There's a saying that I like, and it goes, there's old traders, there's bold traders, but there's no old bold traders. So by keeping my account organized, not getting greedy, and position sizing properly, and knowing how to hedge and use insurance to keep me protected, can help me become that old trader. And one last thing on risk that I want to talk about is accepting it. A recent poker hand I watched, I don't know why I'm talking about poker so much, but Neymar, the soccer player, was playing high-stakes poker with Jimmy Butler, Dan Bilzerian, and a bunch of other celebrities and poker players. And he was in a hand with Alan Keating, who had a flush draw against Neymar's pair, and they decided to run the river twice. Keating won the first run out, and Neymar won the second, so they ended up chopping the pot. But Keating was like, hold on, let's do another side bet of $50,000 for another run out. High-stakes games, they kind of let you do this kind of stuff. But misses his flush again, so Neymar wins. And then he says again, but for like $100K this time, and Neymar wins again. And he continues to do this like 6 more times and loses every single river until finally he lost his entire stack. So what should have been a break-even hand for him ended up being over a $500,000 loss. So the point is, there's going to be trades that don't work out. It's all part of the game. And it's important for me to accept the losses, take the stops, and move on to the next trade. Instead of trying to fix a completely broken trade, only to end up losing more than I should have, and just wasting way too much time and effort and becoming a slave to these shitty trades. So that's all I got today. Leave a like if you enjoyed it. As always, I appreciate you for being here, and I hope to see you on the next one. Peace.
Let's see how you do under pressure. Yeah, I've been wanting this shit forever. I've been in the field with whatever they throw at me. Brush it off, pick myself up, moving on to the better. Okay. Hey. Yeah. Ain't no errors, baby, it's a new era. I wake up early, feeling rich like I'm Kesha. I get to the paper.